In today's video, we are going to talk about whole life insurance. We'll talk about what it is, how it works, what not to do, especially if you're interested in the cash value piece. We'll talk about how that works. And then lastly, what to do if you're interested in a policy. Let's start with what a whole life insurance policy is. A whole life insurance policy is a policy that lasts for your whole life, meaning as long as you keep that life insurance policy active, meaning you don't voluntarily cancel it, it doesn't lapse, you still have that policy on your life. When you die, the life insurance benefit is paid to your beneficiaries. Again, it lasts for your whole life. You'll also hear the term permanent life insurance sometimes. So the opposite of that would be a term life insurance policy. A term life insurance policy is usually a very inexpensive life insurance policy. An example would be I could get a $1 million 20-year term life insurance policy. So I get a $1 million policy, it lasts for 20 years, and it costs me $500 per year. So that's term life insurance. A lot of people are familiar with that. With a whole life insurance policy, the first policy I get lasts for my whole life, meaning I do not need to renew it at any point in time. This product is typically used by individuals, small businesses, and even large corporations. When you look at large corporations that are pumping money into whole life insurance products, in many cases, their interest is the cash value piece. We'll talk about the cash value and why corporations are interested in it, but you'll find that individuals and small businesses can copy what corporations do. It's really cool when you see how a policy works. That was actually my background. Before I got into the business owner world, I had a back office job where my role was designing policies for corporations. Specifically, we would take whole life insurance policies, set them up for corporation on the top 5 or 10 executives, and the goal was really maximizing that cash value short-term and long-term. It's very common to work with someone that's interested in a life insurance policy for the cash value and say, I don't care about the death benefit. I'm getting this because of the cash value. So what is a whole life insurance policy? It's a life insurance policy that lasts for my whole life, and I also have cash value that comes with it. How does it work? So let's go through exactly how it works here. So when I look at a whole life insurance policy, I've got 3 main pieces. I've got my death benefit, money I can pay in, and then the cash value. So let's start with money that I pay in. We've got 2 terms here, your premium and then also your PUA rider. So with your premium piece, which is money you can pay into the policy, this is guaranteed not to increase after you start a policy. So if you get a whole life insurance policy and your premium is $1,000 per year, that's what it is when you start, that premium is never going to increase. You'll see in your contract language that the premium is guaranteed to be level. So you've got a premium that's level for the life of the policy. It's called a whole life insurance policy. That means you have life insurance for your whole life. Do you have to pay into it for your whole life? No, you do not. You'll find that you can pay into a policy for 2 years, maybe it's 5 years, maybe it's until a certain age, or you do plan to pay into it forever. Maybe you stop and go, or you don't know what you want to do when you start, and you adjust after you start. My point is, you are not obligated to make premium payments for your whole life. Most people we work with don't do that. It's very common to see people want to fund a policy for 10 years or less. Some go longer, but a lot of times people want to fund it for a shorter period of time. So premium dollars, it's level, that amount will not go up, and I do not have to pay into it forever. Then I've got my PUA rider. This is optional, adding money here. So I can decide to add money every year. So maybe it's 3 years in a row. I want to add extra money here. PUA stands for paid up additions. I like to call it a cash dump-in because it accelerates the cash value growth. Then maybe I skip several years, decide to add money again, and I repeat that pattern for some time. My point is, this is an optional rider with a life insurance policy where I have the option to add additional dollars to the life insurance policy. When I add additional dollars here, it immediately builds cash value. It also purchases me additional whole life death benefit. So by adding money into this rider, you get cash value immediately, which you'll see begins to earn interest, the guaranteed rate, and any dividends. And it also pushes my death benefit up too. A lot of people like this rider, and you'll see when we talk about the cash value more, this is extremely important. So that's how you get money into the policy with those two areas. Then you've got your death benefit. I don't really like this word. I don't like the word because I've got the word death in it. But it's called a death benefit because a benefit is paid out upon my death. So if I have a life insurance policy on me for $1 million and I list you as my beneficiary, what happens is when I die, you get that $1 million death benefit. The death benefit is also paid to you as the beneficiary 100% income tax free. So I don't have to pay ordinary income tax on that. So if it's $1 million or $10 million, whatever the dollar amount is, again, there's no income tax. Now, death benefit proceeds are not exempt from estate taxes. So if I have a very high net worth and a large taxable estate, the death benefit will not be exempt from that. In cases like that, we'll often see tax attorneys or insurance agents and financial planners set up a life insurance policy that in many cases is owned by a trust, sometimes an LLC. You can have a creative tax planning strategy put in place. But I just want to clarify that the death benefit is paid income tax free, not estate tax free, not automatically, that is. And death benefits work the same with all types of life insurance, whether it's whole life, term life, universal life, doesn't really matter. Then we've got the cash value, baby. So this is what everyone is interested in. I should say everyone we work with is interested in this and how to get as much cash value as possible. So what you'll see with a life insurance policy is that your cash value goes nowhere but up over time. Regardless of what's going on in the stock market, economy, it doesn't matter, it continues to appreciate. So I'll hit on 3 very brief bullet points with the cash value. And there's more to it than this, but this is meant just to provide a very, very high-level overview. Number 1, it's safe. So a lot of corporations put boatloads of cash here because it is a safe place to put money. You'll also hear of a term that's called BOLI, stands for bank-owned life insurance, which is banks purchasing cash value life insurance. And in many cases, they put as much as they possibly can into this product. And a big reason why is because of the safety. So it's a safe place to put money where I see my money appreciate over time as well, which is very attractive. Number 2, I have access to it. There's a couple ways I can access the money. You'll see a lot of people attracted to policy loans. Now we've got more videos on this, which you can check out. But just to give a high-level overview of why people are attracted to policy loans is because I can access my cash value through a loan if I want to. And when I take a loan against it, I keep earning interest on the money that I've loaned and the money that I have not loaned. It works a lot like real estate. So if you own a piece of real estate and the fair market value appreciates at 5% every single year, let's pretend it was worth $100,000, the property value, and you elect to borrow $50,000. Will you have interest due on that $50,000? Yes, you will. Where does the interest go? To the bank on a home loan. However, even though you have that loan outstanding, you still get that 5% on the full property value. It works the same way with a life insurance policy. And you've got a lot of flexibility with policy loans too, where they're not even required to be paid back. And sometimes it makes sense to. Sometimes if I'm in retirement, it might not make sense to. But that's just a very high level overview of policy loans. And then the third benefit to the cash value and why people are attracted to it is if I follow IRS guidelines, this is really your agent doing this for you, you can access the cash value tax-free. So let's say IRS rules followed. Because there are a couple instances where taxes can occur with the cash value. If I cash it out and there's a gain, if I trigger what's called a modified endowment contract, that's where the IRS views your policy not as life insurance, but as a taxable investment. We want to prevent that. And it's typically very, very easy to do. Again, if you're getting a policy, you usually don't need to know exactly what rules to follow in every detail. Your agent does mainly. And as long as you have basic awareness of what not to do, you'll be okay. Like, it almost never happens with respect to a taxable event occurring, that is. But that is an overview of how whole life insurance works. I put money in, I build cash value. When I die, a death benefit is paid to my beneficiaries, income tax free. A lot of benefits to the cash value too. Make sense? I hope so. Okay, let's keep that chart just so we can reference it later if needed. And let's hit on the two important items here. First, what not to do. So if you're interested in a policy, maybe it's for life insurance, but you have a big interest in the cash value. First, let's hit on what not to do. Because where buyer's remorse occurs with life insurance, every time I've seen it, that is when someone gets a policy because they're interested in the cash value. They're told all of these so great things about it, and they get it, and they're like, what's going on? Like, I got no money in the beginning, and it's taken me 10 years just to see a positive return. Why on earth would I do this? So with a life insurance policy, what I would not do, especially if you're interested in cash value, is just buy a life insurance policy, which you could say, wait a minute, like, Steve, isn't that how you get life insurance? You buy a policy. That's the case with term insurance, and you could do that with whole life insurance, but I would not do that. So here's why. If I just buy a policy, let's say the death benefit is $1 million, and I am 30 years old. I'm a young 30-year-old, very healthy. I remember when I was 30. The premium will depend really on the insurance company and product, but if it's a traditional policy, it might be about $12,000 per year. Call it $1,000 per month. We're going to look at an example of this. But if I take that approach, meaning if you come to me and say, I want a whole life insurance policy, give me a $1 million policy, so I know my beneficiaries are guaranteed this amount, that when I die, they're going to get $1 million. And I say to you, okay, it costs $12,000 per year. We can set it up for monthly payments. You can pay $1,000 per month. Sound good? All right, let's move forward. There's no way I would do that. Here's why. From a cash value benefit, it's not going to look attractive. I would not do this knowing what I know. When you pay money into a policy, remember the two areas it can go? That premium or PUA rider. Here's what you'll find. When you pay money into a life insurance policy, it can go toward these two areas. Premium dollars do not give you any cash value in the beginning. So usually the first year, I'll see a zero there. Whereas PUA dollars, remember what we called it earlier? A cash dump in. They show up in cash value, or the majority does right out of the gates. The reason why is because when I look at the death benefit, premium dollars don't give me cash value because they buy me death benefit. The insurance company is going to overcharge me for the cost of insurance or the death benefit up front. Whereas PUA dollars, they do buy me some life insurance. If you put $1 in here, you'll probably get another $3 or so in life insurance coverage. But if I put $1 up here into the premium, well, that might get me $50 or so. It's going to range depending on the product and such, but you get a lot more life insurance from the premium dollars. So the life insurance company says, okay, we're going to overcharge you for the premium up front, so it does not build any cash value or equity initially, but you do have life insurance protection. As you keep paying that premium, it will build cash value, but it's going to take a long time. We want to make sure you're really vested in this policy. Whereas PUA dollars, they don't get you very much death benefit, so the liability to the company is lower, but you see them show up in cash value immediately. Does that make sense? Let's look at an example here, and we'll start with this. And again, this is what not to do. So here we've got a policy for a 30-year-old individual. This is an actual illustration, by the way, which is pulled from this. Here we go. With a good life insurance company, one of the 4 major mutuals. We've got $12,550 per year. I paid it for 20 years in this example. You could pay it forever, but we don't want to pay it quite that long. So we stopped the payments after 20 years. You could keep going. 20 years is just easier because it all fits on this Excel workbook. That's why I did that. So we're price quoting $1 million, $12,550 per year, all premium, nothing in your PUA rider. So as we look at this guy, takes 14 years just to get our money back. By the 20th year, I've paid $250,000 and I've got about $340,000 in cash value. So it took a long time to get my money back. This is an example of price quoting a life insurance policy. This is exactly what I would not do. This is where people have buyer's remorse. I get a whole life insurance policy because I hear about the benefits of cash value, but then I just see it takes so long to get my money back. And people are like, why would I do this? And in many cases, they just cancel them before they even see a positive gain. It takes too long. And I'm also locked into a premium. So if I go back to that example, you're on the hook for your premium every year. So I'm committing myself to a big dollar amount. And really, you have to ask, why am I doing that? So that's what not to do. What should I do? Here's what you can do. You can still pay $12,000. Let's do that first. So we'll pay $12,000. But what we're going to do is set that premium at about 10%. It'll be a little bit higher in the example I'm going to show you. 10% of the 12K. So in an ideal world, I would do this. That's what I'm on the hook for, the premium piece. So instead of $12,000, it'll be $1,200. And then add the rest here. So that would be what, $11,000, $10,800. If it's 12 per year. 12,550 is what we're going to look at. So let's look at a policy with the same company, but set up differently. Premium, not quite $1,200, $1,400 and change, but here you go. Your out-of-pocket's identical, $12,550 per year. Look at the difference in cash value. The first year, you've got 10 grand. On the example of what not to do, you hit 0 in the first year. Like, why would I do that? No, thank you. Because I can set my death benefit at $1 million, have cash value up front, get my money back sooner. Here's your break-even point, age 35 instead of 43. My point is, you get it back a lot earlier. By the 20th year, you've got $370 instead of $338. So about $30,000, more than $30,000 in cash value, and you have your $1 million death benefit. And if we scroll down, you see a big difference there too. We've got more money from start to finish, and eventually you have a bigger death benefit too on the example to the right. So I'm going to show one more example, but just to recap this point, what I would do if I'm interested in the cash value piece is really get a policy where my insurance premium and expenses are minimized as low as the insurance company will allow, and the IRS will allow to prevent that taxable event. And that's how we maximize the cash value. I know this can be overwhelming. If I were to take away one thing, how do I minimize the premium? A lot of times you can get it as low as 10% of whatever your total is with many of the top companies. Let's look at one last example here, and this will show you what we see a lot. So here's a policy that's set up for high cash value, and this is someone that says, I don't care about the death benefit. What does that mean? It means he's putting in a large dollar amount for the cash value. What we aim to do here is get the same $250,000 in, because the last example, we got $250,000 in over 20 years. Here we're going to do it over 5 years. Check this out. Your base premium, $5,000. This is what I'm billed for. I'm on the hook for the $5,000. This is optional. Now this individual says, I want to add this every year. He decides to do so. Total of 50, column in blue. Gets his money back between years 3 and 4. Check that out. Death benefit's a little bit higher, has to be, to prevent the taxable event, that IRS limit or IRS rule we mentioned before. And there you go. And then the cash value just keeps on growing. And if I want to add more money, I can do that here, but I don't have to either. And this is actually very common with a lot of folks we work with, where I can capture all the benefits that come with the cash value. I have life insurance, and the feeling of not having to add money for a long time, if I can just get a lot of money in up front and then let it grow and use it like a line of credit, a lot of times that's where people really like whole life insurance. So that is a beautiful way, in my opinion, of how it works. And we see a lot of people leverage these products for the cash value, particularly with those types of designs. That was a higher dollar amount. You could do it with smaller amounts as well. So I do hope that this was helpful. If you have any questions, please feel free to let us know in the comments below. And as always, I hope this helps. Thanks so much.